Good morning and welcome to today's webcast, Fall 2024 Tax Update for Not-for-Profit Organizations. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Maggie Elliott, Senior Manager, and Amy Hendley, Senior Manager. With that, I'll turn it over to Amy to get us started.
Thank you, Kiva, and welcome everyone. Thank you for joining us for the Fall 2024 Tax Update. For our agenda today, we're going to provide some election year reminders and updates, a few updates on the IRS, and then Meg is going to cover some regulatory provisions affecting tax-exempt organizations. It's been a relatively quiet 6 months with respect to tax law changes since our last tax update this past May after several active years. "2024 may have been a more active year in terms of lobbying and political activity for exempt organizations. For 12/31 tax year-end organizations that will be closing the books on the year soon, it's time to review calculations for your lobbying and/or political activity that may need to be reported on your 2024 Form 990 and Schedule C. Consulting with legal or tax counsel for assistance with calculating lobbying and political expenditures may be helpful. For fiscal year-end organizations, this calculation and review may need to occur for both fiscal years 24 and 25, depending on when your expenditures were incurred. Reminder that 501c3 public charities may only engage in lobbying activities, which is influencing legislation, but may not participate in political activities or influencing elections. The prohibition on political activities for 501c3 public charities is part of the long-standing Johnson Amendment, which effectively made public charities nonpartisan as part of the trade-off for receiving the various benefits of tax exemption as a public charity. Public charities found to be engaging in partisan political activities will lose their tax-exempt status under current regulations, so something to keep note of. The lobbying activities conducted by C3 public charities may not be substantial in nature, and this is determined by using a facts and circumstances evaluation or by using the lobbying thresholds if a 501H election was filed during the tax year by filing Form 5768. The 501H election thresholds apply to overall lobbying expenditures as well as a separate threshold that's included in that overall limit for grassroots lobbying. Amounts in excess of the thresholds are reportable on Form 4720 and are taxable. And then for private foundations, they are prohibited from both activities, lobbying and political. For those organizations that are C4, 5, or 6 that receive membership dues that may have had lobbying or political activities and expenditures during the year, and they elect to report non-deductible dues to members in lieu of paying the proxy tax, reviewing 2024 expenditures year to date and estimated carry forwards of any excess expenditures that you might have for 24 might be helpful with planning for both adjusting the portion of the non-deductible dues that are provided to members on your 2025 or 2026 dues statements, or for budgeting for reduced spending in the coming years, or a combination of both to offset any carry forward from expenditures that may have exceeded your budgeted amounts for 2024. C4, 5, and 6 organizations that made political expenditures and also had net investment income, there's a proxy tax that's required, and it's reported on Form 1120 POL on the lesser of your total political expenditures or net investment income. And just a reminder, for the net investment income calculation, exempt organizations need to use the donor's carryover basis for calculating the gain on the sales of those donated securities. This isn't often tracked because these gains are generally not subject to unrelated business income tax, so requires a little bit of extra record keeping. For 501c4s, these have been under scrutiny. The House Ways and Means Committee requested information in 2023 as a result of public concerns around C4 organizations potentially operating in a manner that's inconsistent with certain rules specific to political activities, and whether there were any foreign funds that were flowing through C4s to influence politics in the United States. As a result, a few drafted legislative items to be aware of. The first is the Foreign Grant Reporting Act. This would require Form 990 filers to report more detail on grant recipients located outside the U.S., which is on Schedule F. Currently, the Schedule F does not include any identifying information on grantees, so this change could potentially be significant if you have a lot of grants outside of the United States. The American Donor Privacy and Foreign Funding Transparency Act, which would require tax-exempt organizations to aggregate contributions from foreign nationals and then group them by country and make this information publicly available. So very different from our Schedule B, which is redacted for public inspection purposes. And then the last one is the End Zuckerbucks Act, which would prevent 501c3 organizations from providing direct or indirect funding to any official election organization, and would prohibit providing below-cost services, scholarships, subsidies, and other types of payments to state and local governments. While none of this drafted legislation has made any headway since this summer, it will be important to watch how the administration moves forward with the committee's request for information and these findings. And with that, we have our first polling question.
We have our first of 4 polling questions. The question is, did you vote in the 2024 election? A, yes. B, no. C, NA. I'll give everybody a few moments to respond, but just a reminder to participate, please click the button next to the answer you choose and hit submit. I'll give everybody a few more moments here. Okay, and here are the results.
So we've got a pretty active group here, and that's good to see. TCJA, as many of you are familiar with, was passed in 2017 by President Trump. Among the various changes, there are many that are set to sunset at the end of 2025, so starting in 26. A few that may have direct impact to the charitable sector. This includes the reversion back to higher income tax brackets, reinstatement of the personal exemption, reduction of the standard deduction back to pre-TCJA levels, and the reduction of the number of taxpayers able to itemize after TCJA may have negatively impacted charitable giving to some degree, so we'll see whether these provisions may be extended and how that might impact future giving. Along with the reduced number of itemizers, thereby reducing the tax incentive to make charitable contributions to public charities and private foundations. Those still able to itemize will see a decrease in the contribution deduction allowed, going from 60% to 50% of AGI starting in 2026. The increase of the estate exclusion, which was about $13.6 million per individual in 2024, would be halved to pre-TCJA levels, estimated to be approximately $7 million in 2026, adjusted for inflation. The impact to charitable bequests and planned giving may see changes as a result of this provision sunsetting. With many of the provisions of the TCJA expiring in 2025, tax legislation may be a significant priority to the incoming administration. I do want to note that many of the provisions that were significant that impacted nonprofits that were in the TCJA are permanent and will continue to apply to tax-exempt organizations. Those include siloing of unrelated business income, the university endowment tax on net investment income, and the excise tax on executive compensation over $1 million. Some of the proposals that President-elect Trump has made include extending certain expiring provisions of the TCJA and making them permanent. This includes lowering tax rates, the lowered tax rates and adjusted tax brackets, increased standard deduction coupled with the suspension of the personal exemptions, limitations on certain itemized deductions, and to make the increased estate exemption levels permanent, adjusted for inflation. The limitation on the deduction for state and local property and income taxes was capped at $10,000 and was not indexed for inflation as part of the original legislation. And this is one of the TCJA provisions that's set to sunset in 2025. That was a pain point for many taxpayers. Trump has stated that he would not extend this with other provisions noted previously. Trump has also suggested exempting certain types of income, including tips, overtime pay, and Social Security payments from income tax at the federal level. And there's also been suggestion of eliminating or reducing green energy subsidies provided in the Inflation Reduction Act. So if you're currently eligible or planning to claim energy credits, keep an eye on updates related to the availability of those credits. And then the last item of note is the possibility of reducing the corporate income tax rate from 21% to 20%, with a lower rate of 15% for certain companies that meet domestic production requirements. The lower 20% rate would impact tax-exempt organizations that have net taxable unrelated business income. Some outgoing thoughts from Biden's budget proposals that were outlined in the Green Book that was issued in March of this year, both which are repeat proposals from prior releases of the Green Books. They both are related to private foundations and pertain to certain payments that currently qualify towards the minimum distribution requirements, but under these proposals would be excluded or need to meet specific timing requirements for payout. Firstly, payments to disqualified persons, essentially officers, directors, substantial contributors of the private foundation, even when determined to be reasonable and necessary, would not count towards the private foundation's minimum distribution requirement, so would potentially require that the private foundation identify other qualifying distributions to be made either through grants or other activities that meet that definition. Secondly, distributions to donor-advised funds made by private foundations. In order to meet the minimum distribution requirement and qualify as a distribution, they would need to be expended by the end of the following tax year. So this would create additional record keeping and tracking on both the part of the private foundation and the sponsoring organization of the DAF. Just a quick reminder on the Legacy IRA Act, which was part of Secure Act. This indexed IRA charitable rollovers with inflation starting in 2024. And so this was the first increase that we'd seen in approximately 20 years. For 2024, the qualified rollover amount is $105,000. And then this also created the one-time gift, which was originally $50,000. This is also adjusted for inflation and is set to be $53,000 for 2024. The one-time gift is available for those aged 70 and a half, and the full amount up to the index limit must be made within 1 calendar year. The amounts can be separate times during the year or made to multiple different charities. It doesn't have to be a one-time gift to one organization. This gift can be used to fund split interest entities such as charitable gift annuities or charitable remainder trusts that can help provide income in later years and may be useful for donors required to take required minimum distributions and help defer taxable income to later years. Another note not detailed on this slide, very recently in October 2024, Treasury and the IRS issued a news release granting a filing exception for tax-exempt corporations from filing Form 4626, and that's to report alternative minimum tax for corporations. The new 15% AMT on adjusted financial statement income of corporations that have over $1 billion only applies to the income of any unrelated trades or businesses, not the organization's overall revenue as calculated by the proposed regulations. Tax-exempt organizations still need to maintain calculations to support their adjusted financial statement income from UBI, but in the proposed regulations that were issued in September of 24, Treasury and IRS provided a simplified method for determining whether or not a corporation was considered a, quote, applicable corporation, and this method did not take into account the adjustment provided by statute for tax-exempt organizations. Comments on the proposed regulations are due next week, December 12th, to allow time for the IRS to consider the comments and to provide some additional details for tax-exempt organizations being exempted from that obligation. So for tax year 23, no Form 4626, but maintain appropriate documentation. For those of you who have been on the ERC roller coaster, it's been a bit of a wild ride for both the IRS and for those claiming the credit. North of 5 million employee retention credit claims were filed, many of which range from eligible to ineligible, and then there are a small number of claims that are actually under criminal investigation. The processing moratorium for claims submitted after September 2023 that was to allow the IRS to catch up and analyze claims filed was announced in October to have been lifted and that they have continued progress on processing claims. They stated in October that they'll be processing and mailing more refund checks, and so hopefully if you are waiting on a check, you have received that or it is due in the mail soon. The IRS also announced that it opened a consolidated claim process to help third-party payers and their clients resolve incorrect claims filed for employee retention credits. For organizations that have already received the credit, the second voluntary disclosure program did close at the end of November for 2021 tax periods. If you determine that you are not eligible for the claim but filed one and did not make the cutoff for the voluntary disclosure program, withdrawal is still available if you have not cashed your check or you have not received it. The IRS has a specific page for how to complete withdrawal requests under these circumstances if that applies to you. And a final note on the employee retention credits, there is still time to file for a claim. The final filing date for quarters in 2021 is April 15th of 2025. So if you've done your due diligence, work with a reputable service provider, and found that you're eligible for a 2021 quarter, filing is still an option. A little bit of an update on the state of the IRS from its spending report that was issued in June this year, and the tax-exempt and governmental entities program letter from fiscal year 2025. The IRS continues to highlight the same focus areas noted in recent years, including improving taxpayer service and an attempt to reduce the amount of time needed for resolution of taxpayer issues, expanding and improving enforcement activities, and updating technology through their business modernization process, and then building a diverse workforce to better serve taxpayers. The IRS is trying to continue to build the expanding workforce at the IRS after many years of retirements and hiring freezes. So we're hoping to see additional trained examiners and taxpayer service folks in the near term. Through June of 24, the IRS has spent approximately $6.9 billion of the roughly $60 billion that's available in IRA money after the clawbacks. So there's still quite a bit of planned spending on the horizon. There's a couple of slides on expenditure details that we'll talk about shortly. And with the current funding running out in fiscal 2031, there have been additional requests for funding for operation support and that additional technology through fiscal year 2034. Some key takeaways from this graphic that were published in the report are that the IRS is close to halfway through its effort to expand taxpayer services and about 1/3 of the way through its budgeted business systems modernization process. So taxpayer services shown in the far left in blue were intended to include filing assistance and education, account services, taxpayer advocacy services, as well as support for elderly and low-income taxpayers. The business support and modernization shown in orange, second from the right, has the bulk of the spending allocated for contractor support at $1.3 billion, IRS labor costs, and equipment maintenance at about $280 million. Operation support consists of normal operating expenses for the expansion of these various areas of the IRS, including overall workforce, payroll, rent and facilities, and then IT development. The most important thing to note on this is that spending for enforcement, which is teal, second from the left, is only at about 3.4% of the current allotment, and the total budget is $24 billion, so pretty substantial. On this next table, we can see that early spending has been focused on taxpayer services, operation support, and that business systems modernization effort. However, over the next couple of years, we will see a considerable expansion of enforcement activity along with operation support to support that expansion of the enforcement activity. So in the current year, fiscal year 2025 through fiscal year 2029, they're working through that $24 billion that was essentially earmarked for these activities. So we anticipate there'll be a lot of additional examination activity over the next couple of years. The fiscal 2025 priority guidance plan was issued in late October, outlining the priorities for the tax-exempt and governmental entities unit of the IRS for the year ending September 30th of 25. Hopefully, the funding from IRA will mean that some of these items that have been longstanding on the priority guidance plan will be addressed. Many of the priorities pertaining to tax-exempt organizations remain similar to past years, with just a few items being taken off the list or being addressed. Some notable items that are still listed that have far-reaching implications for the sector include guidance on the application of regulations under Section 501R affecting tax-exempt hospitals, regulations regarding the allocation of expenses and computing unrelated business income, and then on the next slide, final regulations that pertain to DAS. Then we're at our next polling question.
Thanks, Amy. This is our second of 4 polling questions. Which guidance would you like to see issued sooner by the IRS? A, expense allocations for a UBI. B, private foundations investment in a partnership in which disqualified persons are also partners. C, donor advised funds and supporting organizations regulation. D, guidance regarding the public support computation with respect to distributions from DAF. E, guidance regarding group exemption letters. As a reminder, if you'd like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Looks like we have about 75% of our attendees submitted. I'll give it another couple moments here for everybody to get their answers in. Okay, and here are the results.
So UBI continues to be an area of interest as well as donor advised funds. So those are things that we're both anticipating as well. We're still reporting out on the fiscal 2023 accomplishments letter. The fiscal 24 letter is anticipated in early 2025. Key takeaways for this continue to be the high change rate of the examinations at roughly 76%, as well as pickups being around 40%. So pickup means that if an organization is under examination for one tax area, it is common for the IRS to open an examination in another tax area based on the findings in the original exam. While the total number of examinations for exempt organizations decreased in fiscal 23 from fiscal 22, with about 3,000 exams started in 22 and about 3,400 closed, the change rate remains fairly consistent at around 75%. So they're finding a number of areas that need to change. With the future anticipated increases to enforcement that we just covered from this projected spending, we'd expect examinations both for exempt organizations and other tax areas to increase over the next couple of years. If you receive a notice from the IRS for exam, reach out to legal or tax counsel for assistance. It's never advisable to try to interface with the IRS on your own. Most of the accomplishment letter details we're going to pass over since there haven't been any changes related to those, so we'll leave those slides for you to review at your leisure. And then the last item that I'll cover is the tax-exempt hospital update. So tax-exempt hospitals continue to fall under scrutiny from both government and the public, including many articles and reports, requests, all indicating that some tax-exempt hospitals, not all, may not be delivering in the spirit of 501R. Another letter in a lengthy string of correspondence issued in November 2024 from Senators Grassley and Warren to the IRS expressed concerns that tax-exempt hospitals are failing to meet a prerequisite for their tax-exempt status, and that is to operate primarily to benefit the community. There have been several requested considerations, both from the Senate Help Committee letter in 2023 and this most recent letter in November, some of which that are key to note are establishing minimum level of charity care or community benefit that tax-exempt hospitals would be required to maintain their tax-exempt status, limiting the hospital's tax break or their tax exception to the value of the community benefit that's being provided, establishing clear standards for providing financial assistance, requiring hospitals to determine whether patients are eligible for financial assistance regardless of whether they apply for or request it, imposing further restrictions on extraordinary debt collection processes, and then making requirements for hospitals to address specific needs identified in their community health needs assessments. In the most recent November letter, additional suggestions included increasing enforcement efforts by the IRS, which might include audits, reevaluating tax-exempt status for certain hospitals, and imposing penalties to ensure that community benefit requirements are being met. Prohibiting hospitals from denying care based on outstanding medical bills with the facility. And then most draconian is the reinstatement of the 1956 charity care standard, which was rescinded back in 1969 with the enactment of Medicare and Medicaid. The charity care standard would require that tax-exempt hospitals provide charitable care to the extent of their financial ability, rather than the current requirements under 501c3 and Revenue Ruling 69-545, which have greater flexibility in their interpretation and in the applicability of the criteria that's noted. So some of those include maintaining a board of directors drawn from the community, having an open medical staff policy, providing hospital care for patients who are able to pay and who are not, including those that are utilizing Medicare and Medicaid, and using surplus funds to improve facilities, equipment, and patient care, as well as providing medical training, education, and research. The charity care standard being reintroduced with the belief that with rising healthcare costs and the current medical debt carried by many patients would help with the overall issue of providing healthcare broadly. Other issues and concerns identified from a recent survey from the Consumer Financial Protection Bureau that had 4,000 plus respondents indicated that tax-exempt hospitals were found to have financial assistance policies that were inaccessible or difficult to find, difficult or intrusive financial assistance applications, requiring prepayment for certain services, the use of financial products or offering credit, loans, or other financial options prior to using the financial assistance policy, and then same-day payments for ER treatment, which meant that many people left without receiving care at the emergency room. Increased examination of tax-exempt hospitals by the IRS is likely given expanded funding available and the concerns voiced from lawmakers and other stakeholders. In recent conferences where the IRS has provided comments, they've stated that 501R exams are focused and are set to promote voluntary compliance, and that they're not going into hospital examinations with the goal of assessing excise taxes or revoking the tax-exempt status of the hospital. That may change depending on any pending or enacted legislation that addresses the sector with regard to all of these issues that are being brought. To ensure the 3-year reviews of hospitals go smoothly that the IRS conducts every year for those that are required, and to avoid more formal examinations, focusing on compliance is really the first step. So many of our hospital participants are likely well aware of these requirements. However, I just want to cover a couple of them quickly here. The CHNA, the Community Health Needs Assessment, needs to be adopted by the authorized body of the hospital before the end of the tax year on the 3rd year, following the most recent CHNA. And then the implementation plan or strategy needs to be adopted by the first extension date of your Form 990, so the 15th day of the 5th month after the end of the tax year. Both the CHNA and the implementation strategy need to be provided on the hospital's website and made publicly available for the last 2 reports. For the financial assistance policy, this also needs to be made widely available on the hospital's website, including a plain language financial assistance policy, and then the policy in required limited English proficiency languages that are relevant to the service area. It should also include a list of providers that are covered by the policy, the financial aid application form, and then reference to the billing and collection policy of the hospital. The billing and collections policy is not required to be made widely available, though if not included as part of the financial assistance policy, this is often a request that's made as part of information document requests in exams, especially where the financial assistance policy does not include information about actions that may be taken when payments haven't been made. If the billing and collections policy is separate, the financial assistance policy must refer readers to the separate policy to understand practices around non-payment and also how to receive a copy of the policy at no cost to the patient. And then limitations on charges. Many information document requests explanations for the basis for calculating the charged amounts to patients, so the amounts generally billed. Since the regulations allow for including the AGB percentage in the FAP or indicating that the information may be requested, however, in practice, the IRS is looking either for a specific percentage or to have the financial assistance policy show the calculation, or to describe in the financial assistance policy how the percentage and calculations of the AGB can be obtained. And with that, we have our 3rd polling question.
Thank you, Amy. This is our 3rd of 4 polling questions. The question is, I have seen or received notices about A, payroll taxes, B, tax returns, C, informational returns, D, all of the above, E, some of the above, and F, none of the above. For those of you who would like a copy of today's slide deck, you can download it from the folder that says slide deck and handouts. We will also be sending the slides via email following the webcast. Okay, it looks like a little over half of us have submitted our answers. I'll give it a couple more moments here. Okay, and here are the results.
Thank you, Amy. It looks like a mix of everything. We are still seeing IRS notices. A lot of them are automatic, come out, and a lot of them are erroneous. So as Amy mentioned, I think paying attention, alerting your accounting advisors and or seeking legal advice for those is not unwarranted, especially that many of them still continue to be erroneous. We do still see a lot of issues with the IRS. But we will sort of switch gears into the Corporate Transparency Act. It affects many small and medium-sized businesses across the United States, and it went into effect at the beginning of this year, so on January 1, 2024. The goal of the act is to reduce money laundering and other financial crimes by having entities that are subject to this act provide information about the entity and its beneficial owners. So those would be the individuals, people who own or control the entity. These reports must be filed online with the U.S. Treasury's Department Financial Crimes Enforcement Network, which we commonly refer to as FinCEN. And the website is listed here for reference. And so the question of whether an entity must report and who its beneficial owners does require analysis, and we always recommend seeking professional advice on that. It's not something that we're going to discuss in detail today, but companies created prior to the effective date of January 1, 2024 have until January 1, 2025 to report their benefit ownership information. Those that were created during the current year have 90 days after receiving the notice that registration is effective. And that period will shorten to 30 days for those companies that are created on or after the year end, so January 1, 2025. And of course, any updates or corrections to these reports previously filed must be submitted within 30 days. So the federal regulations provide a list of exemptions for entities that are not considered reporting companies for Corporate Transparency Act purposes, including an exemption for tax-exempt entities. Under this provision, tax-exempt entities, more specifically governmental authorities, credit unions, subsidiaries of certain exempt entities, and even those entities assisting a tax-exempt entity, satisfy the exemption and are excluded from the reporting requirement. However, one important note I wanted to make here is that entities that seek Section 501c status, for example, as a charitable organization, do not become tax exempt until IRS formally approves their Form 1023 application and issues that determination letter. Although many of these entities may be legally formed and operating, the tax-exempt application may not be approved by the IRS within the applicable 90-day or then the 30-day deadline for filing the BOI report. And so while the IRS letter, once you receive it, is retroactive to the date of formation, a newly formed entity is not yet considered 501c until the IRS determination letter is issued. So to avoid possible violation, a newly formed entity awaiting determination should file a report. Once it's approved, an updated report for the new entity would only be required for it to identify it itself and check the box noting its newly exempt status. I do agree this does sound a little cumbersome. And there were some commenters back in 2022 that requested that the exemption rule apply to entities that were still awaiting this determination. FinCEN did acknowledge the request, but the final rule did not include any concession to newly formed entities waiting for 1023 approval. So this would also apply to any organizations that may lose its tax-exempt status. They would have to file this report within 90 days. Unless they could reinstate. Okay, a few e-filing reminders. As Amy mentioned, the IRS is investing a lot in technology. They are heavily moving into everything being submitted electronically. So starting on or after January 1st, 2024, filers of 10 or more returns of any type for a calendar year need to file electronically. Form 990 and 990T are required to be electronically submitted as well. This includes Form 990PF as well. I will touch upon the IRA and those credit filings, but that's the only exemption currently is for the 990T to claim, only to claim the credit, would be allowed to be submitted via paper. And then states, more and more states are moving to online web-based platforms, whether for the charitable registration, renewal filings, or unrelated business income and the corporate income tax filings. For those that do file in multiple states, especially for unrelated business income, probably know the struggle that it is, as many of those returns are not really designed for unrelated business income filings. And so there are certain states that currently do require e-file and will send out notices. And those are Alaska, California, District of Columbia, Florida, New York, Oregon, and Virginia. I recently had a client receive a notice from New Mexico. We are currently not able to electronically submit via our platform, and it does not seem to adhere to the ELF filing requirements. But just know that these states are becoming more and more aggressive, and there's less and less options to opt out of submitting everything electronically. Okay. Switching gears now again to the regulatory provisions affecting tax-exempt organizations, we'll start with the Inflation Reduction Act, IRA, for clean energy credits. It was signed into law on August 16th, 2022, which really changed the field for credits, allowing many tax-exempt organizations and certain governmental entities to benefit from clean energy credits. Energy credits were always available to for-profit entities and individuals in some instances, but they were really never, because they were a tax credit and offsetting a tax liability for those organizations that didn't have unrelated business income or maybe don't have a filing requirement at all, they just weren't available. Someone referred to these as really grants from the government, and that's what I think that's really what these funds are. They're grants from the government for these projects, and IRS is just really good about processing. They have the infrastructure, and they're great about sending out checks, almost too good, as we found out with the ERC credits and all the issues that arose from that. So they did take a very different approach to the IRA. You do claim this refund by filing Form 990T. And as I mentioned, it is not required to be electronically submitted if it is only to claim the credit. You could only claim a credit on your clean energy project placed into service in a given year. For those organizations that may not have a set tax year because they're a government and they've never filed a tax return, nor had they had a requirement to file a tax return, you can choose any tax year and establish that as your year going forward. So for 12/31/2023, the final filing due date for these credits would have been 11/15/2024. So that was just a few weeks ago. But any year end really after that is still eligible. And the IRS did say that for this initial year, at least, extensions are not required. So even if you did not, let's say you have a 6/30, June 30th year end, initial due date would have been November 15th. If you did not file an extension, it's not too late. If you've placed projects into service after 6/30/2023, you could still be eligible and claim your credits. So the tax credits include solar energy panels, alternative energy vehicles, geothermal heat pumps, energy storage technology, and then combined heat and power systems. We'll go into these IRC sections a little bit deeper, but the common ones that we've seen are really on this page. The commercial clean vehicles right in the middle there. We are seeing a lot, I think, a lot of cities, counties, governmental entities, and alike are investing into an electric fleet of vehicles. And so that is a common one. And a vehicle's up to 14,000 pounds, so just a standard vehicle is eligible for $7,500 credit, and larger vehicles up to $40,000. Then solar panels is another common one, and under 1 megawatt in size, you don't have to meet the labor requirements, which is domestic and certain wage requirements. And so if you're over that size, you must meet those labor requirements, but those would be quite large projects. So I think for those that are planning any of these, it's worthwhile to take a look and make sure that, if you're looking to fit within certain requirements, that you assess what makes sense. Generally, the base credit is 30% of the construction costs. And then there's additional 10% sort of add-ons for, one is a domestic content production, and then if you're in an energy community. For the EV chargers and alternative fuel stations, the one requirement that's critical is that it must be in a low income or non-urban areas. There is a map available where you could search by an address, and it's sort of a yay or nay. You're either in it or not. But please know that 100 Main Street and 102 Main Street could be different. So it's worthwhile, again, if you're thinking about putting a project in place or planning a project, that you check whether or not it makes sense to put in a certain location, or maybe choose a different location because of these opportunities. And so for if you are in a low income or non-urban area, the base credit would be 6% of cost plus 30% bonus if the prevailing wage and apprenticeship requirements were met. And so, as I mentioned, with the ERC, the IRS ran into a lot of trouble as far as processing payments and sending out refunds to those individuals that were maybe not filing proper claims or fraudulent claims in many cases. And so for this IRA, they took the approach that the projects will have to be registered. So they must be registered first at pay.gov. And there's a special website that you register and claim your projects. And then once the information is requested and submitted, the IRS reviews it. They are asking to allow 120 days to do this, and they approve your project. You get a registration number, which is then required to be reported on the 990T filing, and you are good to go. So please know that right now what we've seen in practice is about 45 to 60 days to review and approve these registrations. Again, it might change depending on the influx of these filings. We definitely have seen a lot more entities that are interested, entities that really kind of at the beginning didn't believe that this was an option and this is real. And so do allow, as you plan, for 120 days. That does shorten the timeline because you have to have placed the project into service, you have to register it, and then you still have to prepare the filing. So just know that there's some timing constraints there. So if you're planning particularly anything that's large, I would definitely advise you to think about what makes sense. And with that, Kiva, we have our last polling question.
Thank you, Maggie. This is our final polling question. The question is, does your organization have any projects that might qualify for the IRA credits? A, yes. B, no. C, not applicable. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate in the CPE progress window. All right, we'll go to another moment here. Okay, final call for any last submissions. Okay, here are the results.
Okay, so we have a small percentage of, well, 1 in 5, I would say, may have something. And really, this is just to, spread awareness, and especially as you're planning, maybe purchasing properties and things like that. That's definitely something to consider. Okay, our last topic for the day will cover the proposed donor advised fund DAF regulation. So 17 years after the enactment of the Pension Protection Act, the IRS and the Treasury released the first installment of proposed regulations relating to DAFs on November 13th, 2023. I know this was covered in the spring update, and so really there's nothing tremendously new, but the 2023 to 2024 priority guidance plan divided the DAF rulemaking project really into 4 parts. So the regulations under Section 4966, which we'll discuss today, and those that we'll have to keep waiting for guidance on, which include regulations under Section 4967, and what constitutes a prohibited benefit, regulations under Section 4958 regarding DAFs and supporting organizations, as well as guidance regarding public support computation with respect to distributions from DAFs or the tax treatment of DAF distributions. Due to the overwhelming response, the comment period for proposed regulations was extended to February 15th, 2024 from the original due date of January 16th. And please note that proposed regulations will become effective only for the tax years ending after the date that they are published as final regulations in the Federal Register. So these long-awaited regulations reflect and elaborate on the DAF rules in IRC Section 4966. They provide clarifications, examples, and definitions of undefined terms under Section 4966 that generally mirror definitions of those terms elsewhere in the code. They did not stray beyond the statute to impose additional restrictions on DAFs that some critics advocated. They also did not provide guidance on private foundation use of a DAF, more than incidental benefit, or impose restrictions such as imposing the annual minimum distribution requirements on DAFs. So since 2006, DAFs have been defined under Section 4966 D2A as a fund or an account, a separate fund or an account that is owned and controlled by a sponsoring organization, which must be a public charity. And note that contributions to a DAF will not be deductible if the sponsoring organization is a Type 3 non-functionally integrated supporting organization. And with respect to which a donor or an appointed advisor has the privilege of making recommendations regarding distributions from or an investment of the fund. And so certain distributions from DAFs are subject to a 20% excise tax. The excise tax is payable by the DAF sponsoring organization, but Section 4966(8)(2) also imposes a 5% excise tax on a fund manager. So individuals at the sponsoring organization managing a DAF distribution who agrees to make a DAF distribution, for example, knowing that it's a taxable distribution. So a fund will be treated as a DAF only if it is separately identified by reference to contributions from one or more donors. Prior to the proposed regulations, it was assumed that if a fund did not reference the names of donors, it would not qualify as a DAF, even if those donors, for example, had advisory privileges. However, the proposed regulations now make this a possibility. While the proposed regulations refer to a separately identified account as arising where the sponsoring organization keeps a formal record of contributions made by a donor, the lack of a formal record would not necessarily mean that an account is not a DAF. Instead, a facts and circumstances test would apply with the following factors tending to show that a fund is separately identified. So under the proposed regulation, a donor would be defined as all persons, including organizations under section 7701A1, that contribute to a fund or account of a sponsoring organization, but it would explicitly exclude from the definition of donor any public charity other than a disqualified supporting organization described in section 509A1, 2, or 3, and any governmental unit described in section 170C1. If there is no donor, then the fund is not a DAF. And for example, a 501c3 organization can set up a scholarship fund at a community foundation and not have to fall within the DAF scholarship fund exceptions. So the donor advisor would include any person appointed or designated by a donor to have advisory privileges regarding the distribution or investment of assets held in a fund or an account of a sponsoring organization. So in addition to expending three key elements really in this definition of a DAF under section 4966, these proposed regulations also highlight and fortify some traps for the unwary in this IRC section. So for example, persons who collectively advise on investments in or distributions from a given fund, such as advisory committee members, could be considered donor advisors vis-a-vis that fund, even if they did not donate to the fund, unless they meet a narrowed advisory committee exception or another narrow exception. The proposed regulations would treat an investment advisor managing the investment of or providing investment advice concerning both DAF assets and the personal assets of a donor to that DAF as donor advisor, unless, again, that investment advisor is an employee of the sponsoring organization or provides services to the sponsoring organization as a whole. Consequently, any payment by the sponsoring organization from the DAF to the donor advisor from the investment advice would be a taxable distribution. So it would be subject to that 20% excise tax. Further, the investment advisor would be a disqualified person of the sponsoring organization and thus liable for an excess benefit transaction excise tax on the payment by the organization, regardless of whether payment is reasonable or excessive. But the IRS and Treasury have requested comments on circumstances in which a personal investment advisor should not be considered a donor advisor for these purposes, as I know that has brought a lot of discussion in this sector. So the termination of advisory privileges would also be based on a broader analysis of facts and circumstances. So any of the following factors would be sufficient to establish that a donor or donor advisor has advisory privileges, regardless whether the donor or donor advisor actually exercises these rights. So proposed regulations also provide that service on a committee that advises on distributions or investments of a fund or account would constitute a form of advisory privilege, even when the sponsoring organization controls the selection of committee members consistent with its required ownership and control. The proposed regulations do outline two special exceptions, including an exception where members of an advisory committee are recommended by a donor or a donor advisor, and the recommendation is based on objective criteria related to the members' expertise. And the second being the committee consists of 3 or more individuals, a majority of whom are not recommended by the donor. And third, the member is not a related person with respect to the recommending donor. And we are almost at time, so we will not go through the details of distributions and taxable distributions. But you will see here on one of the last slides the funds that are accepted from the definition of the DAF. And with that, I will hand it over to Kiva to close us out.
Thank you so much, Maggie and Amy, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast, but please feel free to reach out to either of our presenters if you have additional questions. We invite you to visit our website for more information on the topics discussed today, many of which are linked in the handouts window. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is now available to download in the CPE progress window. I'll keep the webcast console open for a few moments to give everybody a chance to download their CPE certificate. A copy of your CPE certificate will also be emailed to you within 3 weeks, should you have any difficulty downloading it now. Finally, here's a link to our survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.